We're drawing to the close of an incredibly brutal year. 2022 has been savage for a lot of risky assets. So shall we start by looking backwards? And if we're in a room with a lot of the IQ retail investors, how would you characterize 2022 and what the machine has said about financial markets over the last 12 months?
It has been an incredibly active year, lots going on. And if we take a step back, what we see is that really the only game in town for most of 2022 was the Fed and other global central banks. We came into the year with inflation incredibly hot. We had had major fiscal expansion over the COVID period. And when we started the year, real interest rates were in deep negative territory. So what we started to see from our macro framework was that around February, March, the sensitivity of global equities to real interest rates started to increase. Essentially, what that's really saying is that when you look at these little variations, daily variations in equity prices, equity indices, that was increasingly tracking the small daily variations in real interest rates and expected Fed policy rates and ECB policy rates. And so the machine was picking out from this sea of noise that, hold on a second, what central banks do is now driving equity markets. And that really continued. And as we moved towards the market pricing a 2% Fed rate and a 3% Fed rate and a 4% Fed rate, we saw equity markets decline. And something interesting happened at the end of September, early October, and that was that we started to see other measures of borrowing costs start to ease and come down. And in particular, one of the things we saw was the cost that corporates pay to borrow money for 5 years had actually started to drop in early October. The framework picked out that actually, if you look at overall financial conditions, they started to ease in early October. And that indicated that equities should actually bounce. And so we saw a nice bounce from mid-October. We're quite vocal about the fact that financial conditions are now easing, and that gave a tailwind to global equities, and we saw this sort of bounce. We saw two pretty vicious bear market rallies during the course of 2022. One in August, another one in October, and the overall macro framework identified both of those quite clearly. They were both tradable rallies. They had different reasons. Overall data gathering machines started to figure out that financial conditions were having an easing during those two sharp rallies. And looking at the previous one in October, that really saw the market bounce well over 10%.
So it sounds like the machine had a good call throughout 2022, both helping investors time these bear market rallies and also giving you a good degree of transparency on what the overall macro picture was like. Is it still the same? Is it still all about financial conditions and what the Fed does? What's the outlook as you start to look ahead to 2023?
Really interesting question. And we have started to see a significant shift in what's really impacting equity markets. And we're starting to see that what goes on in the real economy now, real GDP growth and credit conditions, is now more important than the Fed or the ECB alone. We have been hearing for a very long time all this stuff about inverted yield curves pointing to recession. We haven't had a recession yet in 2022, and the market has really been trading off really the Fed. That is now shifting. And the thing to watch in 2023 is whether the cumulative effect of monetary policy tightening and higher rates and higher borrowing costs and higher corporate borrowing costs is now going to translate into weaker economic growth across major global economies.
how would a retail investor actually gain transparency from IQ in terms of understanding this hard versus soft landing debate that you're describing about the economy? And how would they kind of therefore action any signal? How would the signal manifest itself?
So there are two benefits. The first is you now know what to watch, and it's really watching the economic data releases very closely. Retail sales, industrial production, non-farm payrolls, PMIs. And so it's less about listening very closely to every word that the Fed and the ECB say, and it's more about watching the growth picture, the economic growth picture very closely. So that's point number one. Point number two is that you now want to start looking at which assets are more resilient to a real GDP growth slowdown and which assets perform better under that scenario. So you can use QI to ask questions like which sectors are vulnerable to the growth slowdown scenario. Typically, those will be consumer discretionary, industrials, other very cyclical sectors. And you will see lots of signals coming through on our Discord platform in the signals channel, very likely highlighting those assets that are vulnerable to that sort of scenario. And you want to look for those sectors and assets, whether that's fixed income or defensive equity sectors and defensive equity plays that are going to be resilient to a growth slowdown. Yeah, I mean, looking at 2022, the very aggressive rise in US real rates dramatically strengthened the dollar. We saw other effects. The energy price shock and geopolitical uncertainty was very bad for the terms of trade for the euro. And what we are seeing now is a bit of a shift. That sort of dollar supremacy story is fading. And what we see going forward is, from what we can see, a period of more dollar weakness.
The other risky asset that we should be focusing on, credit. And I think you've been emphasizing the point of just how integral credit is to the broader kind of capital markets, and really credit spreads are affecting a lot of other assets, as well as being something you can trade yourself. So do you have a quick overview on how to look at credit for a retail investor who maybe doesn't get their hands dirty in that area so much?
It's really important to look at this corporate credit cost, which is the cost that corporations, and particularly look at lower rated, weaker rated corporations, the cost they pay to borrow for 5 years. And you have this high yield credit spreads that our big machine sort of pulls in as a key variable. Now, the reason that's important is because what it reflects is the expected default rate for US corporates, and European high yield corporate spreads reflect the expected default rate for European corporates. Now, one of the really interesting things that's happened in 2022 is that although the Fed's been hiking rates really aggressively, and so have other central banks, economic growth hasn't yet been severely impacted. And you read in the literature and the studies that typically it takes around 6 to 9 months for monetary policy to impact the real economy. So as we move into 2023, those 6 to 9 months are up. Now, when you look at the default rate for US corporates over the last 12 months, it's around 2%. That is on the low side. So we haven't really seen the impact yet. Now, in 2020, once the COVID crisis hit, we saw that default rate hit 6%. And in the great financial crisis, we saw that default rate hit 10%. And so if we see economic weakness going into 23, the expected default rate is going to increase. And the way you track that in real time is by watching credit spreads. That's what credit spreads are really telling us. That is now a really key variable to keep an eye on in terms of understanding what equity markets are going to do. The nice thing is that if you're on our Discord channel and part of our community, we are constantly updating you on where those credit spreads are and what the picture looks like. Unfortunately, it's not the easiest bit of data to get your hands on, but we have access to that and we share that with the community. And we'll keep you updated on what credit spreads and corporate borrowing costs are doing and how that corporate default rate is evolving over time.